Okay, so we are now going to look at the benefits overview and providers of benefits. This still relates to the syllabus objective on meeting the needs of stakeholders, particularly the first point under that topic on meeting the needs of the stakeholders, where we describe the main providers of benefits on contingent events. So now, looking at benefits overview and providers of benefits, I'm gonna jump to that section on my notes. Benefits overview and providers of benefits. So as I said, the syllabus objective is that we have to describe the main providers of benefits on contingent events. There's also a syllabus objective from topic 14, which is, I'll tell you now. Topic 14 is, it's on having an understanding of the principal terms used in financial services, investments, asset management, and risk management. Have an understanding of the principal terms used in financial services, investments, asset management, and risk management. So, but then the main objective is that one on describing the main providers of benefits on contingent events. So yeah, that is the main syllabus objective. So if I scan through the notes, we have about how many sections? 3, 5. We have 6 sections. So we have an introduction to benefit schemes, we have benefit providers, we have the state, we have employers, we have individuals, financial institutions, and other organizations. We have 6 sections. So, okay, so looking at the summary of the notes, there's a type of scheme, defined benefit, defined contribution, and hybrid schemes. And then there's benefit providers, the state, the employers, individuals, financial institutions, and other organizations. And the state as the provider of benefit. The major roles played by the state are direct provisions of benefits, for example, on retirement, death, or illness, sponsoring of the provision of benefits, provision of financial incentives, education, regulation to encourage or compel benefit provision, regulation of benefit providers. The state can also provide financial instruments, for example, the issue of bills and bonds, savings plans, deposits with the state bank. So those are the financial instruments of the state. And then employers have a variety of reasons for sponsoring benefit provision. Compulsion, number one is compulsion or encouragement from the state. It is either compulsory or it is encouraged by the government. The attraction and retention of good quality staff, the desire to look after employees and their dependents, to pool expenses and expertise. So benefits can be provided through a formal employer-sponsored scheme. This can ensure a consistent approach across employees or help the employer target certain groups. For example, long servers or high flyers. Such schemes could be set up to offer members a choice of benefits. Organizations can tailor the benefits offered to employees using a flexible benefit systems. Under a flexible benefit system, employees can trade in some of their existing benefits for other financially equivalent benefits. Employer-sponsored schemes do not have to be backed by a single employer, but can be sponsored jointly by many employers. For example, industry-wide schemes. And then there's individuals. So as part of being beneficiaries, individuals can finance benefit provision, right? As part of being beneficiaries, individuals can also finance benefit provision. The motive for this can be compulsion, which is meaning it is compulsory, or encouragement by the state or employers. It is either compulsory or it can be encouraged by the government or their employers. And the motive can also be the individual's personal preference. So the provision can be fully structured savings, the provision can be formally structured savings plans generated by the state, employers, or other financial organizations. Alternatively, individuals can make informal unstructured arrangements. Individuals may use domestic products. Individuals may use domestic property as an investment to meet retirement needs, or they may benefit from property through inheriting it. And then financial institutions and other corporations, the vehicle for providing benefits is often provided by financial institutions, either via employer-run schemes or directly to individuals. Institutions are also proactive in highlighting the need to individuals to make provision. Other organizations such as trade unions, credit unions, and charities can also advise individuals on provision, right? So going back to that part of the summary that says type of scheme, we have defined contribution, defined benefit, defined contribution, and hybrid scheme. Defined contribution, we said the scheme rules define the benefits independently of the contributions payable, and benefits are not directly related to the investments of the scheme. The rules define the benefits independently of the contributions, meaning we define the benefits by the rules without depending on the contributions that have been paid, right? We set the benefits without looking at the contributions. And benefits are not directly related to the investments of the scheme, meaning the contributions to the scheme and the investment performance of the scheme don't define the benefits, right? Where they say benefits are not directly related to the investments of the scheme. The scheme may be funded or underfunded, may be funded or unfunded. So the scheme undefined benefits, the scheme rules define the benefits independently of the contributions payable, and benefits are not directly related to the investments of the scheme. The scheme may be funded or unfunded. Undefined contribution, the scheme provides benefits where the amount of an individual, the scheme provides benefits where the amount of an individual member's benefits depends on the contributions paid into the scheme in respect of that member, right? Increased by investment return and on those contributions. So undefined contribution, the benefits to the member of the scheme are defined by their contribution. Whatever that they have contributed to the scheme as an individual member will determine their level of benefit. So their contribution will earn some investment return. So both the contribution and the investment returns on those contribution will determine the level of benefit for an individual member. And then in a defined benefit, we define the benefit first without depending on the contribution and the investment returns of the scheme. And then hybrid schemes. And then hybrid schemes. A hybrid scheme is a scheme where the risk is shared between the different parties involved. For example, scheme members, employers, insurers, and investment businesses. So on defined benefit, defined contribution, and hybrid schemes, someone takes the risk. So in a defined benefit, there is a risk that is taken by the individual member and the sponsor of the scheme. Similarly, with defined contribution, there's also some form of risk that is taken by the individual member and the sponsor of the scheme. So, but then we'll not look into those risks at the moment, but then there are some levels of risk that should be considered. And then going back to the beginning of the notes, so that was just the summary. Excuse me. So that was just the summary. Now going back to the beginning of the notes. So remember that our main objective here is to describe the main providers of benefits on contingent events. Contingent events, we are talking death, disability, critical illness, ill health, longevity risk, meaning reaching retirement is a contingent event, living longer a contingent event. So now we're going to describe the main providers of benefits on those contingent events, right? So okay, so the notes start with an introduction to the world of pensions in the first section, section 1, which is an introduction to benefit schemes. So that's where the notes start. They start with an introduction to the world of pensions in section 1. So they say if you work in pensions, you should be able to. Okay, let me skip this part. All right. So straight into the introduction to benefit schemes. So the idea of this section is to give us a taste of the key concepts in the world of benefits. The comments are framed around a pension scheme, although similar concepts would apply for other types of benefit schemes. Right? So the key features of a pension contract is that the key features of a pension contract are they are primarily used as a means of providing income in retirement for individuals and possibly their dependents. They may provide other benefits, for example, a lump sum payment to dependents if an individual dies before retirement. They may have options to change the form or timing of the benefit. They may have options. So these are the key features of a contract, of a pension contract. They are used to provide income in retirement for individuals and their dependents. They can provide other benefits such as a lump sum payment to the dependents of the member if the individual member dies before retirement. There may also be options to change the form or timing of the benefit. For example, an option at retirement to exchange a portion of the pension payments for a cash payment. But I think this has changed in the South African landscape given the introduction of the two-pot system. There may be some restrictions there on the flexibility of changing the form or timing of the benefit, because now under the two-pot system, at retirement, it is compulsory to use 2/3 of the savings to buy an annuity, right? And the other 1/3 can be taken as a lump sum. So that option of exchanging a portion of the payments for a cash payment may not necessarily apply to in a South African landscape or in a South African context. So that is just some of the features. And another key feature is that pension contracts are long-term arrangements. Who provides pensions? Pensions may be provided by a range of providers. In particular, they can be provided by the state or through the private sector. meaning the government can provide pensions such as social old age grant in South Africa, or they can be provided through the private sector, such as buying a retirement annuity, right? So they can be provided by the state or through the private sector via occupational schemes or personal pension plans or arrangements. Occupational schemes are schemes offered by occupational. When you talk about occupation, we mean employment. If we search occupational in Google, the definition of occupational means relating to a job or profession. So when they say occupational schemes, those are schemes that are offered by employers to their employees, where the employer usually pays a substantial percentage of the cost of providing the benefits, right? And then there's personal pension plans or arrangements, usually purchased from an insurance company by an individual, such as the retirement annuities. So the occupational schemes are set up by employers who are normally defined as sponsors of the scheme. So in that arrangement, the employer, as the sponsor of the scheme, will pay some set contribution into the scheme, and the employee will also have employee contributions to the scheme, right? So that is an occupational scheme. And then personal pension plans or arrangements, that is when an individual buys a retirement annuity. It may be on top of their already existing occupational scheme, right? Or I think it's also common among self-employed people such as musicians, athletes, those who may not necessarily have an occupational scheme set up because they are not employed or formally employed, they are self-employed. So personal pension plans or arrangements do provide some sort of platform to those self-employed people to purchase an annuity, right? Say they do have some savings and they reach a retirement age, they can approach any of the financial institutions that have these kind of schemes and purchase a retirement annuity, right? And then the types of pension scheme member. So those were the who provides pension, occupational schemes, personal pension plans or arrangements. And then now we're on types of pension scheme member. Scheme members can be divided into 3 types: active, deferred member, current pensioners. Active members are members still earning future pension benefits over time. For example, the current employees of a company, of the sponsoring company. Active members are members still earning future pension benefits over time, such as the current employee of the sponsoring company. Deferred members are members who have stopped earning any future benefits, but who have an existing benefit entitlement that will come into payment in the future. For example, an employee who used to work for the sponsoring company but has now left the company to work for another company, right? Those are deferred members. When they reach retirement age, whatever that they have contributed to the occupational scheme when they worked for company A will be deferred until they reach retirement age. Say they are currently 30 and they resign from company A to join company B. They do have some contributions into the scheme of company A. So those will be parked until they reach retirement age if they did not transfer their savings into company B's scheme, right? So if they just leave them there, I think it's called preservation fund. They will be put into a preservation fund. I may be wrong, but that is what's happening. So they just park their funds or their savings into company A's pension scheme or pension fund, and then they start afresh with company B's pension scheme. They start contributing into company's B scheme, and then when they reach retirement, say at age 60, whatever that they've saved or left when they left company A to join company B, whatever that they have saved will be combined with their contributions that they have with company B into a single pooled fund to buy a retirement annuity. Or I think that's how it works. So those are deferred members. Then current pensioners, those are the members who are receiving their benefit entitlement. So people who are already in retirement. Those are the types of scheme members: active, deferred, current. Then the main types of pension schemes. The three types of pension schemes that we discuss is defined benefit schemes and defined contribution schemes, and the hybrid schemes. The hybrid schemes. Defined hybrid schemes. Those are the hybrid schemes. Defined benefits, defined contributions, hybrid. So the type of scheme drives the type of benefit provided and where the risk lie. That is primarily with the member or primarily with the employer as the scheme sponsor. And then there is government sponsored or state sponsored and occupational schemes. Those can be defined benefit or defined contribution in nature. Personal pensions are almost always defined contribution in nature. Right. So defined benefit schemes. A defined benefit scheme is one where the scheme rules define the benefits independently of the contributions payable, and benefits are not directly related to the investments of the scheme. The scheme may be funded or unfunded. Benefits will be defined by a set formula and might be linked to, for example, how long the member works for the sponsoring company or the member's salary at retirement. So the formula, those could be the inputs into the formula that define the benefit. We could be looking at how the term of service to the sponsoring company and the salary at retirement. So a final salary scheme is a common example of a defined contribution scheme. A defined benefit scheme. And then defined contribution schemes. In a defined contribution scheme, this is one that provides benefits where the amount of an individual member's benefits depend on the contributions paid into the scheme in respect of that member, increased by investment return earned on those contributions. The member may have some choice as to which asset classes their contributions are invested in, right? So the pension is not defined. So the benefit is not defined at outset or by a formula. We look at the contributions and the investment returns on those contributions, right? So the pension is not defined at outset, and it will depend on the investment returns achieved by the asset classes that the individual member chose. So the member will need to use the accumulated funds at retirement to meet their post-retirement needs. The member may have a choice at retirement, dependent on regulation, as to how to use the fund. For example, the member might choose to secure a pension with a life insurance company by purchasing an immediate annuity. Alternatively, for an occupational scheme, the pension may be provided directly by the employer. So to move the member also has the option to move the accumulated funds to an income drawdown product where the fund remains invested and the member draws a regular income. I think this is what's this type of annuity again? I forgot this type of annuity where they just draw down from whatever that they have saved. Okay, I'll remember it. Oh, it's a living annuity, yeah. So the accumulated funds to an income drawdown product, they may have the option to move the accumulated fund to an income drawdown product where the fund remains invested and the member draws regular income. I think that's a living annuity type of arrangement. They may also have the option to take the money as a lump sum cash amount, although there may be tax implications associated with this approach. Again, this may no longer be the case in South Africa given the introduction of the two-pot system, where we have the savings pot and the retirement pot. Whatever that's in the retirement pot, 2/3 of that has to be used to buy an annuity, and 1/3 can be taken out as cash, and there may be some tax implications. Okay. And then now defined ambition schemes. I think those are the hybrid schemes. Okay, that is the defined hybrid scheme. Hybrid scheme. It used to be called defined ambition schemes. Now it has to be changed to a hybrid scheme. So a defined hybrid scheme is one where risk is shared between the different parties that are involved. For example, scheme members, employers, insurers, and investment businesses. So the range of alternative types of such schemes is very wide. Examples of defined hybrid schemes that are more defined benefit in nature include cash balance schemes, where a defined lump sum is provided at retirement as opposed to a defined pension through retirement. You define a lump sum as opposed to defining a pension. So another one includes schemes where the retirement age is increased for future service in light of increasing longevity. In this case, the variable retirement age means that the post-retirement longevity risk is transferred from the employer to the member. Increasing the retirement age transfers the longevity risk from the employer to the member. The post-retirement longevity risk is transferred from the employer to the member. Okay. So another one is the greater use of risk management options such as investments that transfer longevity risk, longevity swaps and bonds, and insurance company investments. So in this way, the risk is shared between the employer and the provider of the investment scheme, usually an investment business or insurance company. Examples of defined hybrid schemes that are more defined contribution in nature include defined contribution schemes that offer minimum investment guarantees or minimum retirement income guarantees. Defined hybrid schemes aim to offer the best of both worlds to members, although administration may be complex and members may not fully understand their operation. And then who bears the risk? The type of pension scheme is the main determinant of who primarily bears the risk. These risks inevitably result in either their benefits received being less than expected. This risk inevitably results in the in either the benefits received being less than expected or the cost of providing these benefits being greater than expected. So the benefit may be less than expected. So given the risk, the benefit may be less than expected, or the cost of providing the benefits may be higher than expected. So the key risks relate to investment, increasing longevity after retirement, and expenses. So other risks include credit risk, such as the failure of a counterparty, such as an insurer, and then operational risk, such as fraud, system failure, regulatory changes. Okay, so there's an example here on who the investment longevity expenses risk predominantly lie with in the defined benefit scheme, defined contribution, and hybrid scheme. When the main benefit in a hybrid scheme, the main benefit is defined contribution in nature, but there is a promise that the pension won't be less than 1% of the final salary per year of service at retirement. So in a defined benefit scheme, the members' benefits are promised and independent of investment return, longevity risk, longevity and administration expenses. So the risk therefore lies primarily with the employer. For example, if the investment returns are poor or members are living longer than expected, then the employer needs to pay more money into the scheme in order to be able to provide the benefits. And then in a defined contribution scheme, the risk lies primarily with the members. For example, if an investment performance is poor, then each member's accumulated funds will be smaller than expected and hence the annual pension lower than expected. If an annuity is purchased at retirement, then longevity risk passes to the annuity provider at that point, although annuity rates will reflect the annuity provider's views of future life expectancy. So if an annuity is not purchased, then longevity risk does remain with the member. If they outlive their savings, that's on them, right? But then if they buy an annuity and then they live longer than expected, the insurer who's providing that annuity to the member has to continue paying the annuity income to that member, even if they live longer than expected. So that in that case, the longevity risk has passed from the member to the life insurer, right? And then expenses risk may lie with the employer or the members, depending upon whether the expenses are met separately by the employer or are met from charges taken from the accumulated fund. Okay. So, and then investment on the hybrid scheme, investment longevity and expenses risk will be shared between the members and the employer. To the extent that the experience is poor, but the pension should still, in a hybrid scheme, investment longevity and expense risk will be shared between the members and the employer to the extent that the experience is poor, but the pension will still be greater. To the extent that the experience is poor, but the pension would still be greater than 1%, right, of the final salary of for each year of service. Then the risk lies with the member. If the experience is poor, but the pension is still guaranteed to be greater than 1% of the salary, then the risk lies with the member. Right. Once experience sinks to a level where the defined contribution pension is less than 1% of final salary for each year of service, then the risk is also taken by the employer. Okay, this is not really clear, but I'll just keep it for now. Doesn't really make sense. I'll just keep it for now. And then okay, we've covered that. The other risks include credit risk and operational risk. Credit risk, the failure of a counterparty, such as an insurer. Operational risk, fraud, system failure, regulatory changes. And then looking at investment strategy. Investment strategy. The pension scheme will need to consider the characteristics of its liabilities, in particular the nature and the term, the nature of the liability and the term of the liability when determining the investment strategy, right? The pension scheme will need to consider the characteristics of its liabilities, their nature, and the term when determining investment strategy. The term of the liabilities could be very long, right? For example, a hybrid scheme may need a mixture of fixed interest bonds to match benefits guaranteed in monetary terms. Fixed interest bonds, for example, a hybrid scheme. Now we're looking at investment strategy, right? In a hybrid scheme, for example, there may be a need, we may need a mixture of fixed interest bonds to match the benefit guarantees, to match fixed interest bonds to match benefit guarantees. In a hybrid scheme, for example, a hybrid scheme may need a mixture of fixed interest bonds to match benefits guaranteed in monetary terms, index-linked bonds and equities to match benefits guaranteed in real terms, for example, linked to price inflation or salary growth and expenses. And also a mixture of some cash for liquidity to meet immediate pensions and expense outgoes and uncertain outgoes, for example, any death benefits. For a defined contribution scheme, the member may have investment choices. For a defined contribution scheme, the member may have investment choices. For a defined contribution scheme, the member may have investment choices. Investment choices, okay. The member may have investment choices because they choose the asset classes to invest in. It may be more difficult to determine an appropriate strategy for a defined hybrid scheme dependent on the benefits offered by the scheme. Pension schemes often receive generous tax breaks relative to other investors, which can influence investment choice. The investment strategy of a pension scheme is also constrained by regulation, so they can't invest as they please, right? This can restrict or prescribe what the scheme invests in. All right. Paying for the pension scheme. In defined benefit scheme, the cost of providing all the benefits is not known with certainty until all the benefit payments have been made. There may be some flexibility as to when the money is set aside to pay members' benefits. The cost of providing all benefits is not known with certainty until all the benefit payments have been made. There may be some flexibility as to when the money is set aside to pay for members' benefits. At one end of the scale, no money may be set aside in advance, and the money found just as each benefit payment is made. This means the scheme is unfunded and the benefits are being financed on a pay-as-you-go basis. That is how the basic state pension works in the UK. Alternatively, the scheme may be funded. This means money is set aside before the benefit payments are made and investment returns can be earned on that money. Most occupational schemes are funded. In a defined contribution scheme, money is almost always set aside gradually over the member's working lifetime. The timing of when the money is paid into the scheme is key, since the money needs to be invested at the right time to earn the investment returns that will provide an adequate pension. Looking at provisioning, what is provisioning? Let us just get a definition of provisioning. What is provisioning in general? Provision means to provide. Ne? Provision means to provide. Provision. So this is the definition of provision from Google. So provision means to supply with food, drink, or equipment, especially for a journey. It means to set aside an amount in an organization's accounts for a known liability. So that is provision, to set aside, to provide, to allow for. All right, so provisioning. So for a defined benefit scheme, it is a regulatory requirement to check that the scheme has enough assets to meet its liabilities on a regular basis. The financial position of the scheme is expressed by the funding level of the scheme. For a defined benefit scheme, it is a regulatory requirement to check that the scheme has enough assets to meet its liabilities on a regular basis. The financial position of the scheme is expressed by the funding level of the scheme. This is defined as the value of the assets divided by the value of the liabilities. So, from work experience, a funding level is calculated as being the market value divided by the book value. The book value represents the liabilities in this case, and then the market value represents the assets. Okay. So that is a funding level. It is the ratio of assets to liabilities. And then for a defined contribution scheme, defined contribution schemes are not subject to the same regulatory valuation requirements. This is primarily because the value of the liabilities of the scheme, that is the fund value, is directly related to the value of the assets that the fund is invested in. Setting contributions. Defined benefit schemes. The contribution needs to be sufficient to meet the cost of the future benefits being earned by scheme members. The cost of the benefits, the contribution needs to be sufficient to meet the cost of the future benefits being earned by the scheme members. Any shortfall or surplus that has to be cleared because the funding level has fallen below or risen above an acceptable level. The contribution need to meet any shortfall or surplus that has to be cleared. Okay. Defined contribution schemes. The contribution rate will be defined in the scheme design. Defined contribution scheme. So in a defined contribution scheme, the contribution rate will be defined in the scheme design. It may be age or service related, and members may have some choice as to the amount they want to contribute, right? It may be age related or service related, and members may have some choice as to the amount they want to contribute. So that is pension schemes. That is benefit schemes.